Hi class, Dr. Scott here. Let's talk inventory, chapter 5. First, we're going to talk about the significance of why we talk so much about inventory, and then we're going to practice using some of the techniques like LIFO, FIFO, average cost, specific ID. But to start out, I want to share with you the significance of inventory. And we're going to take a quick look at something called EDGAR. I think we've talked about that before. It's sponsored by the Securities and Exchange Commission. Any publicly traded company has the information on the 10K, the annual report, for every filing for every publicly traded company here in the US. This is what you're going to use for your projects. So I'm going to do search company filings. And when I go to filings, it's by company or fund name or ticker symbol. I really prefer the ticker symbol, but the company name is doable on a search. So I'm going to go there. And let's take a look at the largest tobacco maker in the US. You might have guessed at Philip Morris. I believe their ticker symbol is PM. Actually, let me confirm that. I'm going to go in and say, all right, ticker symbol for Philip Morris. Sure enough, trading at 73.8 per share at New York Stock Exchange, PM, right there, ticker symbol. All right, so we're going to go in and we're going to do that search for PM. And once we get there, we see we got 8Ks and 10Qs and a whole bunch of things. I told you I wanted a 10K, right? So if I do 10K, I hit return, I get nothing. It is because the syntax is pretty fussy. You need to type in the dash. So if you type 10-K, we should have a winner. There we go. 10K for 2020, 2019. These are filing dates, February. So pretty recent this year, back in February, 3 months ago. And I'm going to go to interactive data. And from interactive data, we're going to take a look at a whole bunch of things, but we're going to go to financial statements. Click on financial statements. Notes the financial statements are there, tables, cover, all that good stuff, but I want financial statements. And I go down here, and there's a balance sheet and a parenthetical. I think I'm going to want the real balance sheet. But where would the income statement? I have a statement of earnings. They have a consolidated statement of earnings, a statement of comprehensive earnings. Well, let's see. Which of these is my income statement? It doesn't say income statement, but let's look at statement of earnings. Oh, it has revenues. It has expenses. It has down to here net income. Net income of this is a million, so we get $7 billion net income, down from last year, 7.9 billion, December end, year end 2018, up from 6 billion even, we're almost in the previous year. So they made $7 billion bucks. Now look at the statement of comprehensive earnings. That's our comprehensive earnings. That starts with net earnings. That doesn't sound like an income statement. It adds, oh, this is a comprehensive income. So this is not what we want. Make sure you get a statement of earnings, statement of operations, or income statement, as we want to be called, all kinds of names. We're going to look at the balance sheet. And we get cash. We get inventory. We get tobacco leaf to the tune of $2 billion. That's a million, yep. We've got other raw materials, 1.5 billion. We've got finished product of 5.6 billion. Total inventory of $9.2 billion. Out of 20 billion in total current assets. And we have total assets of $43 billion. So we got 9 billion out of 43 billion in inventory. So let's do a little bit of analysis. As a matter of fact, the quickest way, I'm going to view Excel document with this. Because this is powerful. It'll jump you right into an Excel spreadsheet. And I'm going to open it up. And we're going to look at a spreadsheet. And we're going to say, what are we going to say? All right, I'm going to look at the statement of earnings, statement of comprehensive earnings, consolidated, whatever. I want to get to a balance sheet. All right, consolidated balance sheet. There we go. So I'm looking at the balance sheet, and I'm saying, okay, we've got, I'm going to insert a column here. So insert, enable editing first, sorry about that. So enable editing. It's going to now let me edit the spreadsheet. I'm going to insert a column. Bear with me a second. So we're going to go and insert a column, and I'm going to calculate a percentage. And that percentage that I calculate will be the percentage, what is the value as a percentage of my balance sheet, as a percentage of total assets, what percent is inventory? So I take my total inventory number, which is right over here, of 9.3 billion. I say equals that divided by this number down here, which is my total assets. That's total assets there. And I get 20, let's see, let's make that percentage. I get about 22% of my balance sheet being inventory. Say 22%, that's a lot. As a matter of fact, if you looked at all kinds of companies like retailers, a big part of their balance sheet would be inventory. If you look at Big Lots, 50% of their balance sheet is considered inventory. I'm going to narrow this column very cleanly by double clicking right there. So that'll make it nice and neat, clean. Double click there and double click there, making it shorter. So I get 22% of my balance sheet inventory. Now, if I look at this and I say, okay, I've got $9.2 billion. Let's write the number out. 9,200, that's in thousands, that's millions, that's billions. Okay, so I got $9.2 billion. If I told you the interest rate was 5%, okay, we'll make that percentage just to make it look nice. 5 is 5%. And I take equals that times that, I'm going to have, let's make that a little bit more readable, $460 million just in interest costs. So think about that. I have to pay interest every year because chances are we got bonds payable on that debt. So if I went out and said, you know what, I've got $9.2 billion in inventory, I didn't need that much. If I cut that in half, my interest would be cut in half, and I would come up with only $230 million in interest a year if I had half that $9.2 billion in inventory. So if I had $4.6 billion in inventory, I'd have $230 million. That's still a lot of million. That's still a lot of interest. That's still a lot of cost. So you look at that and say, okay, what are my costs of inventory? First of all, the inventory, which is usually financed, so the term of bonds payable. Okay, and with bonds payable, I look at that and say, I can spell bonds. That would be helpful. So we got bonds payable, and we have interest costs. And I can't do bond payables. Let's do that again. Bonds payable. So forget my spelling. And then, if I can spell inventory, I'd be good too. So then we have other costs. What other costs do we have with inventory? We got to store it. We got to have buildings to put it in. We pay insurance. We pay taxes on the buildings and facilities. We have to maintain the buildings. We need, so HVAC, heating, ventilation, air conditioning. So think about, where do you put a couple $1 billion worth of tobacco leaves? How much space would that take? One of my students here at FMU calculated that you could go from Francis Marion down to MCSU and make a big square, including that diagonal, and that's about the amount of space it would take to store that much tobacco leaf inventory. That'd be a lot of buildings, wouldn't it? So what else do we have? We have security. We have to keep in mind that we're going to have employees that are going to move it around and use it and put it places and stack it. And ultimately we have to ship it somewhere. So all these things associated with inventory are costs of maintaining inventory, not just the debt, not just the interest. So we've got a lot of costs associated we got to think about. So inventory is pretty important to track. And that's why we're going to talk numbers and inventory and figure out how that works. So that's why I wanted to emphasize out of the gate the importance of inventory. Let's go ahead and talk about different methods of inventory. That little pie chart you see shows FIFO, first in, first out, about 48% of folks that use inventory. We get about 28% of companies using LIFO, last in, first out. We get something called weighted average, some kind of averaging method, and then other methods. And we will look at specific ID, which is most popular of those. Cars and boats, you probably do specific ID. Heads of lettuce, boxes of cereal. We're not going to worry about individually tracking specific ID. So first in, first out, last in, first out, weighted average, and specific ID. The other terminology of perpetual and periodic. Periodic means at the end of the month or end of a time period, we count all the stuff, we see what we bought, we see what we sold, and we use that as our total for LIFO, FIFO. We'll see how that works. And when we do a perpetual, we're matching it as we make sales, batch by batch by batch by batch. We're going to emphasize periodic here, and that's probably what will be mostly tested on. But periodic inventory is what we want to talk about. But let's look at some of the methods. So if we talk, and I'm going to talk at LIFO, FIFO, average cost. I'll leave specific ID out of it for now. When we look at LIFO, FIFO, let's say we go ahead and we buy let's add a couple columns here. And we're going to insert. Okay. So we buy 5 units at $10 a piece. That's each. And then we're going to have total price. And then we go ahead and buy another 10 units at $11 a piece. And then we buy 20 units at $12 a piece. You know, costs are up. And say we sold during that time period, well, we bought 35 units. Let's say we sold 31 units. And we sold them for $20 a piece. Before I do the numbers up here, let's break this down to 1 gallon of milk. Or 1 gallon a mile. That'd be a lot of milk in a mile. All right, let's say we bought 1 gallon of milk for $1. Okay. Let's make it better. Then we bought 1 gallon of milk for $1.50. Okay. So we look at that and say, all right, that makes sense. What is my revenue? Well, let's say we sold it for $2. And under LIFO, $2. Under FIFO, $2. Under average cost, $2. And I'm going to actually shrink this up a little bit, make it a little bit more readable, like a bit cleaner, so it's condensed and accessible and understandable, and we get more room in the spreadsheet to work from. All right. So my question is, what is my cost of goods sold? Well, this gallon of milk was purchased, I'll insert there, on 1/5x1. Let's do it 20. And this was purchased on 1/12/20. And it's already May, so that's going to be some old milk, but we won't worry about that. So we look at this and we say, on a last in, first out, the last one in is this one. So we sold LIFO, the cost of goods is $1.50. This one says on FIFO, first one in is the first one we sold. And so we sold that one, $1. Average cost, you say, oh, I can probably do the average of that in my head, $1.75. Okay, and actually, let's see if we can do $1.7175. So it'll give us a date. And then equal that minus that. Now, the next question I'm going to ask is a trick question. Would you rather have $1 in profit? That's gross profit. 50 cents in gross profit? Or 25 cents in gross profit? I'm sorry, $1.25. That's not right. I knew it didn't come out right. Okay, 75 cents, $1, or half 50 cents. And why do I say it's a trick question? Many of you are probably thinking, Scott, don't be silly. I want to make $1. I don't want to worry about a half a buck. I'd rather get a buck and brag about it. I'm telling you, I'd rather show 50 cents in profit for selling the same gallon of milk. Why? Because I have a corporate tax rate of 21 cents, 21%. If I multiply my tax rate times my gross profit, I'm going to end up with 10 cents, roughly, in, let's see if I can widen down a little bit, 10 and a half cents actually. If I go ahead and I multiply my tax rate times my profit here, I'm going to end up with 21 cents. Okay. Now, would you rather pay 10 and a half cents in taxes or 21 cents for selling the same gallon of milk? I'd rather pay 10 and a half cents, personally, half the taxes. Now, the other question, though, is if I was selling this business, if I was publicly traded and I wanted to show off the stockholders how profitable we were, I would want to show the higher profit. I would want to show bigger value. But you can see, based on the methodology that we use for inventory, it's going to vastly affect how we calculate and how we affect profitability based on the different kind of method we used. Okay, so I'm going to go start multiplying this out, that times that, and then I go copy that down here and here. Good to go. So bottom line, you will see that we spent a total of, I'm just going to do some there, get a little fancy, some of that, right here. Okay. I didn't like when I pressed return before. We're going to do the sum. When I do sum, it says, okay, we'll do from here to here. And I had $400 in total cost of 3 different layers. This might have been January 5th. This might have been January 12th. This might have been January 20th. And we sold that on January 25th. All right. So we had 620 in revenue. So I'm going to ask the same kind of questions, and we're going to move this revenue cost of goods sold up here. And I'm going to ask you what the profit is with each of those transactions. Okay. So instead of my $2 a gallon of milk, and actually, I'm going to put it next to it so it'll be a little bit easier to see. Section copy the values. Keyboard on the laptop is fun to use. Okay. All right, so we're going to go here. We're going to shrink that down here. I could actually do a Control-A and mark them all. All right. So what is our cost of goods sold? If I sold 31 units, well, on a LIFO basis versus a FIFO basis versus an average cost basis, we're going to have some differences. So let's figure that out. What are we doing here? If we take our cost of goods sold, we can look and say LIFO, on a LIFO basis, we have to take this amount. We sold 20 of these, and we sold 10 of these, and we sold 1 of these times the original price. Okay. So let's get rid of that right now. Okay. And what was our revenue we had here? We'll about revenue a little while. So our cost of goods sold is $360. How much do we have left in inventory? Remaining inventory is, well, if we sold 31 units, we must have 4 units left. 4 times those 10 units. So you look at that and say, I got 360 in cost of goods and 40 in inventory. You remember this formula? You start with beginning inventory plus purchases. Bit like that, just go purchases. Minus ending inventory equals cost of goods sold, or beginning inventory plus purchases minus cost of goods sold equals ending inventory. And I can't do plus with gracefully. Okay, you get the idea. So beginning inventory plus purchases minus inventory. Why am I underlying that? Probably, I don't know why. Because that gives you cost of goods available for sale. We talked about that. But at bottom line, I want to get to my bottom line of seeing what is my cost of goods sold or what is my inventory. So we've got 360 plus 40 here. When I do cost of goods sold for my other method of calculating inventory, I have how many units sold? I've got 31. It's made up of all of these plus all of these, so there's 15 of it, plus, and let's see, I've got 15, I sold 31, so I got 16 times the individual cost of that layer. So I've got $352 associated with that inventory cost, not 360. And then I say, well, if I got 4 left, I've got equals 4 times those, $12 units. And I got $48 in my inventory. So does that add up to 400 again? 352 plus 48? Sure enough, that adds up to 400. Now my average cost, I got to calculate an average cost per unit. And what are my total units here? I've got 35 here. I'm not going to take total price, doesn't make any sense. My average cost is not $11, by the way. Why? Yeah, my median is $11, but my mean is 400 divided by 35. Let's see, that equals 400 slash 35. So I've got about 1143 per unit. I'm kind of heavily weighted towards my January 20 units. So I look at that and I say, okay, I got an average, but I have a weighted average, not just a straight average. I'm not taking the average of my prices. I'm taking the average of my total prices, the $400 divided by my total units, 35 units. So on average cost, I've got equal 1143 rather, times how many units do we sell? 31 is my cost of goods sold. And my remaining inventory equals the same 1143 times how many units left? Well, if we sold 31 and we had 35 available, we're going to multiply by 4. Not that cell, but number 4. And in theory, I'm hoping that my 354.33 and my 45.72 equals 400. So I'm going to do equals that plus. You see how the spreadsheet can really save you a lot of time. We got a rounding error here because I didn't round. There's a couple of decimal points after the 43, but I'm at $400 total, made up of inventory at 40, 48, 45.72, cost of goods sold at 360, 352, 354. Okay, so what's our gross profit? Well, if I sold, how many units? I sold 31 units times, what's the cost, the selling price per unit? $20. I'm going to go ahead and calculate my gross profit. And we've got 260 versus 268. So what's $8 out of 260? Maybe 2% difference. And average cost is always, forevermore, going to fall in the middle. Okay. So you look at that and say, well, those are different numbers on my cost of goods. It'll result in a different net income, bottom line, in my companies. And that can be pretty significant. So this is why we're doing inventory. This is why we're analyzing it. And this is a sneak preview of how we're analyzing it. So I'm going to stop the video for now, and we're going to go in. I'm going to review the actual other concepts to go with inventory, because we've got 2 videos to go for this chapter. But I appreciate your time, and I look forward to seeing more of you. Hopefully you look forward to seeing more of me. Appreciate it. Thank you.